So it is about Voxy. Voxy, thank you very much. I can see Ngugi has already been able to share this. So then we are told there, December 2022, question number 1B, we are told Voxy Limited, leased a factory to Teana Limited with effects from 1st January 2022. So remember, Voxy in this case is a landlord. Teana is the tenant. So Teana is a lessee, and then of course Voxy is the lessor. The lease is for 4 years at an annual lease rental of 4 million, payable annually in arrears. The lease contract provides that the lessee shall be responsible for the insurance and the maintenance of the factory during the lease term. The implicit rate of interest there in the lease is 15%. They are giving us COC. They're giving us cost of capital required. Demonstrate with suitable calculations the accounting treatment of the above lease transactions in the financial statements of Voxy Limited, who is the lessor. So they don't want you to account using this the perspective of the lessee. They want you to do this in the books of who? The lessor, who is Voxy. You should not be scared. The financial reporting is almost the same. What will change is basically the terminology, but the financial reporting between the two, between the lessor and the lessee, nothing much changes. You're going to have that amortization schedule. Everything will be the same. All right. So ladies and gentlemen, what do we do here? Who can advise me? Who can talk to me this morning? What do you think in this case here will be the very first thing for us to do? You guys are experts here in an exam. What do you think would have been the very first thing for us to do? Thank you very much, Ngugi. Ngugi has already seen this. There is some 4 million being paid there to us every year. So the very first thing we shall do is to get the present value of the cash flows. Let's get the present discounting. Yes, Joshua. Yes. So in this case, here, let's get the present value of the cash flows here. So come and give us the present value of cash flows. There. Of course, in this case here, if it was the lessee would have called this one here present value of lease liability. So for us, this will be our investment. It's our investment. It is our investment. Let's just simplify it that way. First of all, I like the fact that my students have been able to see that the first thing they're going to do here is to discount the cash flows given. That's so nice of you. So ladies and gentlemen, then straight away here, we know the metrics that we need for us to be able to discount, don't we? We know this person will be receiving how much? He'll be receiving 4 million. He'll be receiving 4 million. So in this case here, this 4 million for how many years? For 4 years, and the cost of capital is 15%. So then the very first thing that I would expect my students to do, because this will never be given to you in AFR, is to come and calculate for us the PV firm, present value, interest factor of an annuity. And we know the formula really. It is 1 minus 1 plus R raised to negative number of years. And then you divide everything by what year? By R there. You divide everything by R there. So remember, R is the cost of capital, which is 15%, So then this one here will be 1 minus 1 plus, you see 15% is the same as 0.15. 15% is the same as 0.15. Raised to, this gentleman will be receiving this for 4 years, and then everything to be divided by the same required return, which is 0.15, like that, which is 0.15. So here you have to use your bracadabra. You must be courageous here, calculator. Give us the answer here slowly. You say 1 minus 1.15. Don't forget in this case here to raise in your calculator, -4. After you raise, don't forget to say equals. Whatever you get there, you divide it by 0.15. Give me your answer in 4 decimal places as usual. Give me your answer in 4 decimal places as usual. Give me your answer in 4 decimal places as usual. 2.8550. That's from FE. FE 2.8550. Is anybody who is able to confirm? 2.8549 from Ayaga. Let's be very precise. We're reading what we have from our calculators and we're rounding off to 4 decimal places. 2.8550 is the correct position. Is the correct position. That is the correct position. That is the correct position. Now, ladies and gentlemen, in this case here, we have our total present value. Therefore, our total present value will be the 4 million this guy will be getting every year times our PV-FAR, which is 2.8550. Don't use the figure that is in your calculator. Because you have rounded off to 4 decimal places, please take 4 million times this figure to give me the answer. Give me the answer here. Give me the answer. So what do we have at the end of the day? What do we have at the end of the day? What do we have at the end of the day? So according to Dorothy, it is 11,420,000. This is 11, according to Dorothy, it is 11,420,000, like that. Now remember, the lessee will call this one a liability. But we are the lessors here. We are the landlord. We are the landlord. And of course, as a landlord, I know that this will be what here? An investment to me. So this one is a lease investment. I'll just tell them the examiner here that for the lessor, this one here will be a lease what here? A lease investment. A lease investment. So this one will be called a lease investment. It can't be called lease liability. Would have been liable if you were the tenants. Would have been, in this case, ladies and gentlemen, having this as a liability if you were the lessees. But you see, they want us to account from the lessor's perspective. I told you everything will be the same, apart from terms that will be changing here and there. So thank you very much. Very bright students here. Now, ladies and gentlemen, I've been able to do the first thing that you've told me to do. Hey, get present value of the cash flows. That I've done. So then what do you think will be the next thing to be done? What do you think will be the next thing to be done? Becky Lee's. Discount already, right, Mbabu? We have already discounted. We have already discounted. Remember, here there are two things you cannot do. You can't tell me that, for example, you have a right of use. No, you are ceding that right of use. And again, you can't tell me to depreciate the asset. Why? Because this is no longer your asset. The asset in this case is being ceded to who? Is being ceded to the tenant, who now will be controlling the asset. Remember, it's about faithful representation. It's about substance over form. You can't tell me that you will take this as your asset and yet you have given it away for 4 years. You'll never step it in there. That's not your asset. You've given it away. All right. So in this case here, the landlord, the lessor will not depreciate. So in this case here, then you're right. I cannot even put journals here. The next thing I'll do is that amortization schedule. Don't call it now loan. Just call it what here? Amortization schedule. But even if you call it loan, I mean, we will be able to understand and give you all the marks there. So go ahead and give us an amortization schedule. Go ahead and give us an amortization schedule from the perspective of the landlord. Go ahead and give us an amortization schedule. So we have here amortization. All right. So we have here year number 1, 2, 3, 4. All right. So in this case here, we have the opening balance. So we have here the opening balance. We have interest. We shall call it interest income, but just write it like that, interest. We have here amount received, what you have received. Just call it paid. Amount paid. There's nothing much different really here. So opening balance, interest, amount paid to us. Then we have in this case here the closing balance. The closing balance, like that. All right. So in this particular case, is there anybody who is able to tell us what the opening balance is? The opening balance. It will be the present value of the cash flows that you ascertained up there. The lease investment. The lease investment, which somebody had already given me the value. I've only forgotten it. 11,420,000. 11,420,000, like that. 11,420,000. So is there anybody who is able to remember the rate of interest? Is there anybody who is able to remember the rate of interest? It is normally the cost of capital. It is the cost of capital, which is what here? 15%, which is 15%. 15%. So can you kindly then give me the interest earned out of this money? 11,420,000 times 0.15. It's our investment, remember, that you've been able to put in there. It's our investment, remember. The numbers, I'm so sure the numbers are big, but I always love it that way. They're big, just put them that way. So in this case here, according to FE, it's 13,000. But now remember, this gentleman who has our asset there is going to pay us something. Are you able to remember the lease rentals? How much are we going to be receiving from this gentleman? How much shall we be receiving from this gentleman? 4 million every year, 4 million. So remember, this amount received or paid shall always be in brackets, and this will always be constant. This will always be constant. This will always be constant for 4 years, like that. Always constant for 4 years, like that. So then can you kindly do me a favor? Come here and give me the closing balance. Come here and give me the closing balance. So you're taking this plus the interest earned minus what has been paid to us to get the closing balance there. So in this case here, we have 91,33,000. Very good students here. 91,33,000. 91,33,000. 91,33,000, like that. So you see the closing balance of year 1 becomes the opening balance of year 2. So then here we have 91,33,000. Please let it earn interest at the rate of 15%. Let it earn interest at the rate of 15%. So 139, 136.99, 136.99.50. So we have here 136.99.50. So after that, please come and have this amount growing. So you add this plus this, you subtract 4 million. You give me the closing balance for year 2, which is 650.29.50. 650.29.50, like that. So bring this forward here. So we have here 650.29.50. Please give it interest. Give it interest. 975,442. 975,442. 2.5. Thank you so much, Ngera. Great. So take this, you add here, you subtract the 4 million, give me the closing balance. Is there somebody who is able to give me the closing balance pretty fast? It is 347,839. 347,839, 347, 347, 347. And the students in this case who don't get to talk to me, remember, this subject needs you to, in Zoom, you need to keep on talking throughout. You need to keep on talking throughout. Trust you me, you can't talk throughout and then you fail. 347, 839, 2.5. This is a miraculous subject. It only goes to those students who keep on talking in class. So long as you keep on talking and talking, even if whatever you're talking is a lie. So even when, for example, you are there and you're struggling with your sleep, you simply wake up and raise up your hand, right? You stretch a little bit. These are subjects that needs you to be very proactive. Keep on asking questions. Keep on talking like that. Trust you me, you can't be a backbencher in Zoom and you pass. That one we can bet with you. In Zoom, a backbencher means that somebody must be on their bed. If you're a backbencher, all right, you know what I mean? The concept of a backbencher in Zoom, you have to be at the front here. You must be at the front. You must be at the front. You must be at the front. So this is the figure that you're bringing here. So we have here 347, 347, 839, 839, 2.5. Please give me the interest here. According to Betty Kanana, it's 521, 758. 521, 758. 521, 758. 521, 758. 521, 758. Susan, I can see your question there. Thanks for asking. Remember, we got this figure at the very beginning by discounting the 4 million being paid to us every year. We discounted. I'm so sure Susan must have come in a bit late, but fortunately, you'll be able to get this video, especially if you go to my Facebook page, Joshua Aura ACC Mentor, you'll be able to get, I don't have my videos. They're always there, especially these beginning videos, because I'm using them to market. All right, I always have them mounted there for free, the beginning videos. But of course, as we progress, I'll stop doing that thing of sharing the videos like that. Do you indicate years 1, 2, 3, 4, 5, or 2023? Either way, Edward, but the very best, to be honest, we need to indicate the correct years here. We shall be able to change this. We need to indicate the correct years here, 2023, like that. We shall be able to change. Thanks for that. All right. All right. So in this case here, they are telling me, ladies and gentlemen, that we have here a good question there. So what do we have here? You give me this figure first of all. So we have this plus this minus this. What figure are we getting here, somebody? What figure are we getting there, somebody? What figure are we getting there, somebody? Yeah, 151.37. 151.37. And it's supposed to be what there? 0. Let me ask you a question. 151 bob. What is 151 bob to somebody who has this kind of money? 11 million. What is 151 bob to somebody who has 11 million? Yeah, those are rounding off what year errors. It can only be 0 if you're using Excel, for example. You see, Excel will take, in this case here, all the decimal places. But again, you as my students here, want to warn you, you can't write for the examiner here 151. No. What do you write there? What do you write there? What do you write there? The last one. It has to amortize what year? It has to amortize to 0. Don't write 151 there. You have to be bright. You write a 0 there. It has to amortize to 0. It has to amortize to 0. It has to amortize to 0. Great. I'm seeing good questions here. Let me just go through. You write 0. Insignificant. So Kairugi, if it is the lessee and you calculate depreciation, we leave it at that. Yes. Remember, depreciation will never go to amortization schedule. Depreciation would have been for the asset up there. We should have left it like that. All right. Actually, from what this, I hope is a gentleman, is asking, what we shall do, we shall finish this question as if we are the lessor, the way the examiners asked. And then from there, what do? We shall be able to assume now on the other side of the coin and ask ourselves, what if we were the lessees? How would have we accounted for this transaction? I think that's a good plan for us to even understand this better. All right. So ladies and gentlemen, let's in this case here, look at this question very, very well. So then here we are. Okay. So remember, this is 2023. This is 2023. 2023. This is 2024. It's good to indicate the actual years. 2024. We have here 2025. And we have here 2026. It's good to indicate the actual years. Although even if you leave them like that, there's no problem. Now, ladies and gentlemen, once we reach here, now this is where the rubber meets the road. Out of this, you know, we have this to this person called the landlord, this person called the lessor. These ones here are his assets here. But you need to categorize between these assets, which ones are non-current assets and which ones are current assets. Not many students are able to do that. Not many, trust you me. Very few people in Kenya, very few accountants even in practice will be able to do that. All right. So this closing balance, come and tell us, of course, for this gentleman, these are assets. We don't call them liabilities. Now the shoe is on the other side. So in this case here, we have non-current assets versus current assets. Please write yours in full. Write yours in full. Non-current assets versus current assets. Current assets. What do you think will I do to be able to get? If you get this correctly, honestly, okay, Brian, we shall be able to, let's first of all concentrate with the lessor. We finish the lessor, Brian, and then we'll be able to come back to the lessor. You don't mix issues, really. Is that okay, Brian? First of all, we finish with the lessor. You know, the lessor will not be able to depreciate an investment. And then once we finish, then we'll be able to come to the journals, isn't it? For what year? For the lessee. Shift diagonally. Shift diagonally. I like what Joshua is telling me. This is my namesake. This is my namesake. I've understood already what this guy is telling me. Non-current assets. Non-current assets. Not many people, even in practice, you know, accounting is a science. Accounting is a science. And that is where most of you come, you finish your CPS, even your MBAs in accounting, and then you tell me, we don't have a very good job. It's because you don't take a lot of time to practice and, of course, understand this science called accounting and finance. It's a very beautiful thing. Now, ladies and gentlemen, you see, when we call something non-current, non-current means what year? More than a year. So if, for example, we are here, if we are here in year number 1, look at year number 1, the future cash flows is what belongs to what we call non-current, more than 1 year. So for example, out of these assets, the very first asset I'll call here non-current is this amount. You see this? This is the first non-current because this is what goes more than 12 months. You know, these are 12 months. This now goes more than what year? 12 months. So in short, whenever they want us to give them non-current assets, we shall always use this diagonal. We call it diagonal here. So you pick the first one here. Even if you don't want to reason, the first figure here, 650. 650, 29, 50. And then you copy the others. You can move also this one here. We have here 347, 839, 839, 2.5, you can move like that, 0. And then now for current assets is now what will be paid in the year. How do we get to know what will be paid in the year? It's very easy. So it's very easy. We know that the total figure here is supposed to be 91,33,000. But or rather, what you're pushing forward is this 650. The difference will be paid in the year. The difference will be paid in the year. So you take this minus this. Give me this ugly figure. 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 The first one, you take this minus what is being pushed away. So we have 2630 050. 2630 2630 050. Thank you very much. How about the second one? 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 The second one, you're taking this minus this other ugly figure. It's a match of ugly figures today. It's a match of ugly figures today. Imagine when you're not understanding, just participate. Be proactive. Try to write something. Try to write something. I remember I was also doing some online class, actually last year. All right. And then I discovered that every time, in this case, I got just into class, I felt tired. All right. Very tired, really. Very, very tired. Negative energy. And then I discovered one fine thing in one evening. What I discovered is that every time I took now a book to write down, all right, and I was engaging, in this case here, colleagues here, making fun, at times even drawing that emoji like which is smiling. I liked the class to the very end. I'm telling you, the worst thing you can ever do in any online class is to take a back seat. Like I'm emphasizing again, I'm so sure there must be a ninja, a lady ninja, who is following this class right away in between her white bed sheets. I'm 100% sure. I'm 100% sure. That is the ninja who has taken the very back seat, the very back seat, the very back seat, the very back seat. So 302, 455, 3. By the way, you'll be surprised, and I'm very serious here. Online classes, you should never try to multitask. Never try to multitask. Never try. Not a lady. 455, never try to multitask. Of course, again, here this goes to the ladies, because some of you have kids in primary school. There must be somebody who is trying to prepare their kids to go to school. Please delegate that task. Don't multitask. Don't multitask. 302 like that. And then this one I'll know. This minus this is very good for me. So this is 347, 8, 39, 2.5, and then the last one is what here? Is 0. Is 0. Is 0. And then now this is what you do, my good students. This is now what you do. This is the most interesting part in this question. You know, you haven't yet answered the question, because at the end of the day, you must give us extracted financial statements. So come and give us the income statement extract. So give us the title there, Voxy Limited. Give us the title there, Voxy Limited. The lessor. Income statement extract. Income statement extract. So remember, we have our ES. Remember, we have our ES. We have our ES. Remember, we have our ES. Voxy Limited, lessor, income statement extract. We are just extracting sections of the same. So remember our years, we have 2023. 2023. We have 2024. 2025, 2026, like that. So of course, Voxy will call this one interest income, interest income, interest income. So we'll come and call this interest income, interest income. And then you copy everything that you have here under interest. Big figures, 13,000. So we have here 136, 99.50. We have here 975, 442.5. We have 521, 758. These are just ticks coming your way without even knowing what you're doing. I'm telling you, this paper is all about, it's a science. Once you understand some mechanics here, you can never go wrong. 521, 758, and 58. So that is it. Voxy Limited, income statement extract. So remember, if it was the lessee and we're coming back to the lessee, in the income statement, the lessee would have had two things, interest expense and the depreciation. But you see now here, we are the lessor. Lessors, we are not depreciating. Lessors, we are not depreciating. Lessors, we are not depreciating. We are awake. Thank you very much. Yes, statement of income extract, that is still okay. That is still okay. We are awake. Thank you very much. RW Kurabaridi. So chances are RW is sleeping a little bit, but at least given the fact that he or she is able to type here, that's very good for me. It means proactivity, proactivity, proactivity. All right. So that is the end. And again, you come and give us Voxy Limited, end of income statement. Voxy Limited, lessor, Voxy Limited. Voxy Limited. Lessor. Statement of financial position, extract, or extract of financial, extract statement of financial position. One and the same, really. One and the same. 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 So then we have here the statement of financial position extract for Voxy. So we have our years at 2023, 2024, 2025, 2026, like that. So we start with non-current assets. Non-current assets here. Non-current assets. And the non-current assets, the name is lease investment. Lease investment. So lease investment, the non-current asset is there, that column. So we have here 650 to 2950. The first year. The second year is 347, 839, 2.5, 2025 is 00. And then of course, that is number one. The second thing is current liability. Current asset. Why am I bringing liabilities here? Current assets here. And the current assets, again, you'll book in what we call lease investment. What we call lease investment. So, and you have the figures there for CA current assets. 263, 60, 50. I can't see that number very well, but of course the point is already home. The next one, the second one is 30, 2455, 7.5. And then we have the last one there, which is 83, 92.5. There we have a 0. And then we'll be able to get all the marks. You'll be able to get all the marks. You'll be able to get all the marks like that. You'll be able to get marks like that. All right. All right. Lease investment. All right. So are we ready? So we can now tackle the lessee. Can we go to the lessee accounting for the same question? For the same question, can we go to the lessee accounting? Same question, can we go to the lessee accounting? Lessee accounting. All right, so lessee accounting, I would want us to do this statement. Let's do first of all, for the lessee accounting, let's follow those steps. So for the lessee accounting, what do we have? So for the lessee accounting, let's follow those steps. The same thing, really, the same thing. But this year, they should be able to give us a question where they tell us to do both accounting, and they will be able to disturb students a lot, They'll disturb students a lot. They tell you, do the lessor accounting, and then you do the lessee accounting for even 15 marks. So lessee accounting. So first of all, we get the present value of lease liability. Present value of lease liability. Present value of lease liability. This one here will not change. This one here will always be the same. Will be the same. So is there somebody who can remind us this figure? What was the present value that we got? The present value that we got? Present value that we got? 11 for 20,000. 11 for 20,000. So in this case here, come and pass the journal. We pass the journal. We pass the journal here. So we shall debit, we shall credit. So what do we debit? We shall debit what we call a leased asset, what we call right of use, right of use. And then we credit lease liability, lease liability. Same amount, 11 for 20,000, 11 for 20,000, like that. Now we start making, ladies and gentlemen, in this case here, our arguments here. Remember, this is an asset, right of use. Right of use is a leased asset, yes. So in this case here, the next thing I'll do is to come and calculate depreciation. Calculate depreciation. So depreciation will always be on a straight line basis. So it is 11 for 20,000. We divide by the number of years. Number of years are how many here? Number of years are how many? We divide this by 4 years, isn't it? 4 years, yes. 4 years. So are you able to give me that depreciation per year? So 11 for 20,000, the asset divided by 4 years. Are you able to give me that depreciation per year? Are you able to give me that depreciation per year? 28.55, isn't it? Those are marks that you're getting even without, sweating. There is no hustling there. All right? No hustling there. So after that, ladies and gentlemen, what do you think will be the next thing to do after taking care of the asset? Now we take care of the liability. We take care of the liability. So the next thing we shall do is to draw what we call. Next thing we shall do is to draw what we call what here, somebody? Yeah, the amortization schedule. The amortization schedule. And I've never understood why students of this advanced level, you see, almost every semester, whenever they bring us a question that wants students to do amortization schedule, I'm telling you, out of, so many students, the students will be able to do that amortization schedule correctly will be less than 30 in an envelope that has got, say, 500, less than 30. I don't understand whether amortization schedule, do you find it to be a very hard thing? This table here, the schedule, do you find it to be a very hard thing? Do you find it to be a very hard thing? Do you find it to be a very hard thing, really? No. We shall be able to get it. We shall get it. We shall get it. And remember, it can either come in AFM or AFRA. In most cases, one of the two. And now we have a paper called AMA. AMA also, you can also easily get it there. All right? So it's a very, very serious stuff. Very, very serious stuff. We shall not draw that table here because it's normally a replica. It's normally a replica. The only difference will come here. Now here we'll talk of non-current what year? Non-current liability. And this will be what we call current what year? Liability from the perspective of the lessee. From the perspective of the lessee. All right. And then now you'll come and give us, ladies and gentlemen, here. You'll come and give us, ladies and gentlemen, here the extracts here. So we start with, so in this case here, this guy is called Teana Limited. Teana Limited. Teana Limited is the lessee. Teana Limited is a lessee. So let's see, we start with, in this case here, the income statement extract. Income statement extract. All right, we have got two expenses basically here. Two expenses. We have in this case here interest expense. Interest, you can call it, if you want to shine a little bit, you can call it finance cost. So interest over our years, 2023, 2024, 2025, 2026. Unfortunately, I had dropped mine, but I suppose you guys have this interest expense, isn't it? You have the interest expense, honestly. I don't have to belabor here. That column that has got interest, isn't it? The column with the interest, are you able to feel it yourselves? Don't give me the numbers. I don't want to write. Don't give me the numbers. I don't want to write. I don't want to write. Don't give me the numbers. And then the other one, because now you are the lessee who has the right of use, who is controlling the asset, you must charge depreciation. And depreciation is straight line, so you're going to have the same amount. Depreciation is straight line, so we're going to have the same amount. We shall overcome. Paul, depreciation. Remember depreciation? We got 11,420. The right of use. Depreciation, we had 11,420,000 right of use. So this is the right of use. So right of use is your asset, least asset. So the asset depreciation there, Reen, will be 11,420,000 divided by 4. Because it is straight line method. It is straight line method. Which in this case here was able to give us how much? 28,55,000. So this 28,55,000 is what you write here. 28,55,000 is what you write there. 28,55,000. You write like that because it is straight line. It's straight line. The same amount throughout. Same amount throughout. So Paul, are we together up to here? Paul, have you been able to see now how we computed depreciation? Have you been able to see? Great. So that is it. You smile and go to the next extract. So if we are together, then we shall come here and talk about Teana Limited. Teana Limited, statement of financial position extract. Statement of financial position extract. Statement of financial position extract. Statement of financial position extract like that. So what we have here, ladies and gentlemen, is assets. We shall have what we call our non-current asset. Here we shall have three things: non-current assets, all right, where we shall have what we call the leased asset. We don't call it leased asset really. We shall call it what here, somebody, right of use. If you go, for example, to the financial reports of Kenya Airways, you know, Kenya Airways is big on leasing. Most of the aircrafts you're seeing Kenya Airways, in this case, writing up there, the pride of Africa. The pride of Africa. They're not theirs. They have leased. And this leasing business is what I would also want to recommend to my students. I would want my students here to become big in leasing business. Get to learn how to use other people's assets to make money. That is science. Use other people's assets to make money. Look at, for example, this company called Airbnb. These guys have got no house of their own. All right. So you simply come up with whichever, it doesn't have to be leasing, whichever concept, like for example, the Uber thing, whichever concept, whichever business model where other people are giving you their assets, and then of course you put them in some app like that, and then at the end of the day, what do? You make your money, and then you live well on earth. That is the very best business you can ever do. This thing of owning so many things, no, you need liquidity to advertise. Advertising, marketing is the biggest pillar that any company should be able to do what you to put down. Not owning very big buildings in town, which will be 50% vacant. No, no, no. That should never be something that gives you a headache. Let's lease things. We shall be leasing things. We shall be leasing things, yes. Great, great. So leased asset. So we have here 2023, 2023, 2024, 2025, 2026, like that. So in this case here, remember, the leased asset that we were able to discount to today was coming to 11,420,000. But remember, this thing is depreciating. So by the end of 2023, it has lost some money. I've forgotten that depreciation amount. I've forgotten that depreciation amount. For the ranch, you can only lease the biggest asset there. The biggest asset, ladies and gentlemen, there, the biggest asset is the land. Lease the land. So 28,55,000. So in this case here, less this 28,58,000. 55,000, I mean. You subtract it. Because you see, this 11,420,000 is at the beginning of 2023. Is at the beginning of 20, it's the now. But you see, as the time progresses, it is losing value. So by the end of 2023, it will have lost this. So can somebody give me the value to report on 2023 for this asset? So Timothy Onderi is giving me 8565. 8565. And because this is 2855 is a straight line, please continue subtracting like that. So can you subtract 2855 out of this to give me an answer here? Keep on subtracting like that, and then we move on like that to the very end. Keep on subtracting, keep on subtracting, keep on subtracting, keep on subtracting. Yes, I'll be able to give you, I remember the question very well. And there is a question I never answered from a student who was asking something to do with this IFRS 2. IFRS 2 today happened to be easy. I happen to be free today in the day. Please, we should be able to chat up that question on WhatsApp. On WhatsApp. And how I wish you guys can really market RCM. I think now I'm becoming tired. This thing of having two employers is really, really, really eating onto me. Of course, I have a very good job. Which I don't hesitate telling you I earn more than $1 million from a Swedish company. Very, very good job. But where it has reached right now, so RCM is growing. If RCM would work very hard, I get in this case here like double population, then I should be able to come and concentrate on RCM alone, but I'll be able to miss on so many things, golf club, so many good things. But I mean, I've always believed in employment. Even my wife tells me, why don't you just resign from that job? But I always believe, I don't know whether I'm a risk averse, but I believe in employment so much. Because when I look at my pension statement is very good. Very good because of what your employment. I ever don't know how God came to give me this RCM business, which is also growing very fast like that. But I believe in what here? In employment. Is there anybody who believes in employment like me? Is there anybody who believes in employment like Mwalimu? Or am I the only one? Yes, I believe in employment. Somebody on the other side takes care of what here? The risk. I'll need grace of God. I'll need grace of God. But I think where we are heading to, especially if students can come in and as well help me to market RCM so much, RCM should be able to give me that comfort. Okay, so then we have those figures now. I believe we have the figures. now. Umukua says he believes in business, and people are different. People are different. So if Umukua was Aura today, he would be in his business 100%. I love that kind of courage. I love that kind of courage. 57, 10. Okay. 2025, 28, 55,000, 28, 55. And then, of course, lastly, we have nothing to report in 2026 because the asset is fully depreciated. We have returned, by end of 2026, we shall be returning this leased asset to the owners. To the owners. Yeah, from employment we get, yeah, great. Great. So thank you very much. Thank you very much. Thank you very much. Thank you very much. So from there, ladies and gentlemen, then we can very comfortably come and give our examiner the liability section, because we said that for the lessee, you must recognize the asset and liability at the same time. Liability at the same time. So come here and give us, come here and give us the non-current liability. Leased assets or lease liability, call it lease liability. So lease liability, you will be able to copy. I wrapped mine. These figures that we had here, the non-current liabilities, I wrapped them, but you guys can pick them very fast. And then you come and write here the current liability. You write there the current liability, leased liability. And then, of course, ladies and gentlemen, you have what here? You have the current liabilities here. You copy them for each of the years, and then that marks the end. That marks the end of that question. That marks the end of that question. Have you learned something new there? I hope you guys have your numbers very well. And then, of course, in the spirit of brotherhood, if you've written very well, you can take a screenshot and then you share the screenshot in the group. Brotherhood or sisterhood. All right. All right. All right. All right. All right. We are not talking, ladies and gentlemen. We are not talking. We are not talking. We are not talking. We are not talking. Uh-huh. Uh-huh. Now, remember double entry, basically, perhaps in this case, we don't pass any depreciation double entry here, but I can just remind you guys, double entry, as you go to the field, there are things you're supposed to be knowing. As you go to the field as an accountant, there are things you're supposed to be knowing. One of them, of course, is double entry. For you to be able to enter those figures nicely in the machine, in SAP and whatever, you also need to have some double entry skills, even for purpose of testing systems. So like double entry, always remember pairs like that, pairs. So under pairs, we have this P standing for purchases, expenses and assets. Purchases, expenses and assets. Whenever they increase, you debit. Whenever they increase, you debit. Whenever they increase, you debit. And then we have revenue, company's revenue, any liability, share capital, revenue, liability, share capital. Whenever they increase, you credit. You credit. So for example, depreciation is an expense, which automatically affects the income statement, and it affects the PPE. It affects the PPE. So whenever I have, in this case here, an expense called depreciation, all right, what I'll do, if it's the total figure, I can take the total figure to the income statement. I will debit the P&L, and then I credit PPE, because depreciation is an expense. Or if I'm handling them for individual assets, I'll come and debit depreciation. I debit depreciation. I'll open an expense account called depreciation, a ledger called depreciation. So depreciation account, and then I credit the specific property, plant, and equipment. The specific item, if it's motor vehicle, I credit like that. Because you see, expenses are debited. In this case here, the asset, because the asset is going down because of depreciation, we credit it like that. As an accountant, again, as a science, you need to be very good in terms of what? In terms of this, you have to be very, very good. You have to be very, very good. A PEAL, what do you have here as PEAL? Purchases, expenses, assets. Purchases, P is purchases, expenses, assets. Whenever they increase, we debit their accounts. Revenue, liability, and the share capital. If the owner brings in money, I'll receive the money as an asset, either bank or cash, debit. And then I credit the share capital. So revenue, liabilities, and share capital, whenever they increase, you credit. We shall be looking at this more, especially when we go to the internal reconstructions, external reconstructions, etc. All right. So if you allow me, I will be able to, if you allow me, I will be able to do what here? If you allow me, I'll be able to go to a different exam question. A different exam question, very limited. So now we're looking at what we call sale and leaseback. Sale and leaseback transactions. Sale and leaseback transactions. And the case in question, I would want you to be looking for this question that I would want us to do is December 2021. Question 3A. December 2021, question number 3A. Yes, we shall do that. First of all, let's exhaust this, and then we go to the one, in this case here, that cash flows are done in advance. RCM, we used to go by the name Regional Center of Management. TVET has refused this name center. Now they want us to, so we have rebranded ourselves here to Regional College of Management. Actually, I need to make this official now. Regional College of what year? Management. Regional College of Management, because now they don't want colleges to be calling themselves centers. No. Regional College of Management. We are at Stanbank House. Stanbank House. We are at Stanbank House. First floor like that. Of course, I'm aware that there are so many colleges now which are coming up calling themselves what year? RCM. They want to ride on our what year? They want to ride on our Facebook marketing. All right. So the question is, should I trademark and maybe start fighting with them? No. Those are young people. If they can confuse one or two people and they eat, So let it be. Let it be like that. At the end of the day, students get to know the true RCM, the true RCM, the true RCM. Okay, so I hope I've been able to answer that question. All right. Now, let me ask you a question. For those of you, in this case here, for example, who have beautiful houses, all right, I want to imagine that there must be my students here, some of them who are living in Karen, your own house. Have you ever thought of the amount of capital you are sitting on? All right. You could be sitting on, for example, 100 million, and here you are struggling financially. Is there anybody, for example, who has a dead asset capital at home? You build a very big bungalow at home of 10 million. All right. Do you think in this case here that home of yours at your rural place, can you imagine yourself selling it and then you rent it back? So you sell it, in this case here, you sell it to some landlord, to somebody will be called a landlord now. And then of course you start paying him rent. Do you think that's a good idea? Do you think it's a good idea? Do you think it's a good idea? Do you think it's a good idea? Like, for example, ladies and gentlemen, here we are, like Mwalimu, this is a house that he is in today. I release the capital. Most of the circles nowadays, they're calling it release of capital. If you take your house to the circle will be able to give you loan. They talk of what here, release of capital. Yeah, so at home, it's good to have what? It's good to have a very good place. But please, ladies and gentlemen, let it be modest. If you want to be in business, for those of you like Mokwa who love business, please don't go home competing with anybody. Why should you put up a very big house at home and yet you go to that place maybe once or twice or thrice a year? All right. You know, an asset is supposed to be putting money to your pocket. Once you have that kind of a building, and then of course you're forced to hire somebody who every month will be sending money to, then that is getting money out of you. So it's a liability. It's a liability. I'm not saying that we don't build at home. It's important, but I always advocate for what here, for modesty. A house of 10 million at home, Akikuya will tell you ni kutupa mbao. Ni kutupa mbao. Especially if you've got business ideas. Like you need to be having like a primary school somewhere. You need to be doing a construction, a big construction farm. All right. If you have very good business ideas, please don't tie up lots of your capitals in what we call the dead assets. They're not liabilities because, of course, they're growing in terms of value. That's why we prefer calling them dead assets, assets without a life. All right. All right. If you are organized, if you're financially literate, I would really advocate for this concept of what you're selling and leasing it back. Leasing it back. Usisikie mtu anakuambia analipa rent ya 50,000, unasema tu ni wazimu, ati hapana, mi rent ya 50,000 hapana. Ati I would rather build. I would rather build. So you go, in this case, you're looking for big loans, you get 10 million, you put up a big structure, and then what happens to your businesses? That's how you become an employee forever. All right. So sell and lease back is a big thing. It's a big thing for those of us who made mistakes earlier on, right? We can release that capital by selling whatever properties we have, and then we lease back for us to be able to, of course, continue living in those kind of houses. Ladies and gentlemen, please listen. It looks crazy, but it is the way to go. It is the way to go. I can see somebody raising up their hand. I'm able to know who is raising their hand here, really. I don't know. Let me lower the hand. All right. So I would want to share something very nice here. Something very nice here. Something very nice here. Of course, I know there are those guys who have attachment to what here, to our properties. But you see, that is why most of us, or rather most of our business are dwarfs. Unapata biashara ambao unamake 2,000, 3,000 per day. What is that kind of business now? You need serious businesses, and serious businesses boils down to what here? Financial management. That's why we are teaching you financial management. You need bonds, you need treasury bills, you need good things. Hiki tunapata mtu uko na manyumba kubwa kubwa, unakuja Nairobi unakaa ni kama umeteseka yako yote. I refuse that. So sale and leaseback. I hope you are able to see this. Sale and leaseback. I'll also be able to send you this book. I normally have 2 ACCA books which I work with throughout. It's good you have them. A sale and leaseback transaction occurs when one entity, the seller, transfers a property, plant, stroke equipment to another entity who now is the buyer, who then leases the asset back to the original seller. Please allow me to make this understandable. Look at, for example, ladies and gentlemen, Uchumi Supermarket. So Uchumi Supermarket used to own a very good building, even up to date, at Aga Khan Walk. It is there up to date, at Aga Khan Walk. Very good building, which used to house what its headquarters, right? When they experienced some big financial crunch, what did they do? They got a buyer for that building. So a buyer for that building was looked for, and they got a very good buyer, so that the house was sold. But they went and pleaded to this buyer, told the buyer, I mean, as we sell to you this house, would want to enter into an arrangement where you don't chase us away. We are selling it to you, and then we lease it back for our business. So we sell it to you, don't chase us, would want to continue working from there. So it's called sale and leaseback. Sale and leaseback. So, and whenever there is a sale and leaseback, what are we supposed to know? It is just the usual lessee accounting. Very easy. Let's do this question. So you're told Hen Limited, it's December 2021. Question number 3A. Hen Limited sold a building at its fair value of shillings 112 million. Fair value is the same as market value. To a finance company on 31st October 2020, when its carrying amount was 78.4. So the carrying amount there is 78.4, but you're selling it at a profit, 112. The building was leased back from the finance company for a 5-year period. The remaining economic useful life of the building was deemed to be 25 years. So it could be concluded the control of the building had transferred to the finance company. Lease rentals are 98,56,000 payable annually in arrears. The interest rate implicit in the lease is 7%. The present value of the annual lease payment was 43,20,000. Present value. So this is an examiner who is not wishing you lots of success. You can imagine in most lease questions, the only thing that nobody gets wrong is computation of present value. All the students are able to compute present value correctly, and they earn some marks there. So what do you think of an examiner who is giving you the present value directly? Is he a good examiner or bad examiner? What do you think of that kind of an examiner who gives you present value directly? Is he a good examiner or a bad examiner? Because I mean, that is the only thing that all students are able to do. And then the examiner goes ahead and gives us that kind of he's a bad examiner. He's a bad examiner, yes. He's given us the present value of the annual lease payment there. Here Limited recorded the cash proceeds, they recognized the building, and recorded a profit on disposal of 33.6. How did he get that profit on disposal of the 3.6? Is there anybody who is able to tell me what he did to get that profit on disposal? Amekunyima max, yes. Is there anybody who is able to tell me how they got that profit of that 3.6? I want to teach you how to fetch simple marks in AFR. AFR is about, so in this case here, they took fair value minus the carrying amount. They took the market value. They sold this thing at 112. They sold this thing at 112. All right. And then, of course, the item had a carrying amount of 78.4. All right. All right. All right. No other accounting entries had been posted. Required, with reference to International Financial Reporting Standard 16 leases, and with suitable calculations, explain the accounting treatment of the above transaction in the financial statements of Heri Limited for the year ended blah, 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 blah. Like that. Now, ladies and gentlemen, this is a very funny type of a question, and I'll tell you why it's funny. There is a formula. If you do not understand that formula, then you'll always have problems. Sell and leaseback formula. Very nice formula. Very nice formula. The formula in this case here is the one that we use to get right of use. Here, right of use is never an express thing. It's never an express thing. No, no, no. Right of use, there is a formula that you must always use. And this formula is very easy. Right of use of this asset, it will be present value over fair value times carrying amount. Times carrying amount. So basically, we take a fraction of the carrying amount. We take the fraction of a carrying amount of the asset. We shall recognize a fraction of that carry. Remember, this asset, the way it is, the carrying amount there does not belong to us, the whole of it, because you're going to sell it. We will only be left with a fraction here, a fraction because of what are the leased, the space. Now we're going to have this space for 5 years. So anytime we talk about sale and leaseback, we must always remember this. It is present value all over fair value times carrying amount, times carrying amount. So is there somebody who is able to see the present value? Is there anybody who is able to see the present value? Remember, this December 2021. The question here is December 2021. December 2021. Question number 3A. So right of use formula, whenever they talk of sale and leaseback, I must always remember this formula. So is there somebody who is able to see the present value? These guys are not talking to me now. They're not talking to me now. The present value. Are they able to see the present value? It is 4320. It's 4320. Are you able to see? I'm cutting the 3 zeros. Are you able to see in this case here the fair value? The fair value. At times they use the word market value. Are you able to see the fair value or market value? Fair value or market value? Fair value and wongo. Wongo and. Aki wongo and. Aki imagine 78.4 and sio fair value. Sio market value. Aki ni wongo. Aha. Ningapi somebody? Ni 112,000, isn't it? 112,000 if I'm cutting the 3 zeros. And then the figure that Anne is giving us is called the carrying amount. 78,400 is called the carrying amount. 78,400 is called the carrying amount, which is what year? 78,400. According to Martin Wambogo, it is 28,224. 28,224. This is very, very important for me. 28,224. Right of use. Right of use. 28,224. 28,224. 28,224. Now, ladies and gentlemen, from there, what do you think in this case here will be the next thing to be done? Abracadabra. Now, you've been able to get the right of use. Now, there is a student who will always think that this formula will be applicable throughout. The one of getting right of use. Let me again, for the umpteenth time, remind my students that we only use this formula in which case? When do we get to use this formula? When we have blah, 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 blah. When we have blah, 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 blah. It's only a formula used in situations where there is sale and leaseback. Sale and leaseback. Sale and leaseback. So ukienda kwa exam ukisikia sale and leaseback, you may forget about everything, but we shall remember this formula. We shall remember this formula. Sale and leaseback. Sale and leaseback. Now, after that, ladies and gentlemen, I will come and do what I call incomplete journalization, an incomplete journal. I'll come and do an incomplete journal. I'll come and do an incomplete journal. Do an incomplete what year journal. So you're doing an incomplete journal. I'll be able to complete this journal later when I do other things. There are other things I need to do, but immediately come and do an incomplete journal here. But don't write a title there. So come and tell us, first of all, debit, right of use. 28 to 24. Credit, in this case here, lease liability. Lease liability. Remember lease liability, ladies and gentlemen, will always be equal to the present value of the lease obligation. Present value of the lease obligation. Present value of the lease obligation, which you guys have been able to give me this lease liability. You guys have been able to give me this lease liability. The present value that you guys gave me, there is a lady who gave me this figure, which is 40 what year? 40 something. 4320. Why am I calling it incomplete? Because it is not balancing yet. It's not balancing yet. I'll be able to tell you what we shall be able to do later on to ensure that everything does what here balances. So please leave some space, like 3 lines here. Leave some space, like how many lines here? Like 3 lines there. Leave some space, like 3 lines there. Now, ladies and gentlemen, after that, the next thing that you shall do straight away is the loan amortization schedule. Remember, this is from the lessee's perspective. Whenever the examiner is silent, you always do it from the lessee's perspective. You can only do the lessor's perspective if the examiner tells you, hey, we have Voxy the lessor, do his financial reports. So you're doing the lessee perspective. So go ahead and give us a loan amortization schedule. Go ahead and give us a loan amortization schedule. Loan amortization schedule. Now here, there is something that I've always seen students getting it wrong. There is always something I've seen students getting it wrong. When you talk about the very first year, the opening balance, people take this right of use year and then they get a 0 in the entire table. Remember, this is a loan amortization account that we shall always be using what we call the loan what year liability, the PV. We always work with the PV, the present value. The present value as the opening balance, the figure that you have here. So your assignment, because you need to prepare to go to job now, ladies and gentlemen, your assignment is to ensure that now you complete the entire question. I hope IFRS 16 now is starting to make some sense. IFRS 16, I believe IFRS 16 is starting to make some sense. I can see there, how about depreciation? I'll be able to handle that. But of course, depreciation now will be based on this, which is okay. All right. Great. Thank you so much. See you in the evening. See you today in the evening. If you would want to get more exposure about IFRS 16, remember the evening classes, they are not basically continuation of the syllabus. No. These are basically classes for, how would I call this, weak students who would want like an hour. Actually, I'll even be making them like 30 minutes. 30 minutes in the evening. That is from 6. Should we start at 6? No, yes. No, let me bring a debate. So like, for example, 6 to 6:30. All right. So if, for example, you are in town at that time, you simply go to not cyber cafe, but to a coffee area, right? Open your phone, open your machine, take your coffee. Just for 30 minutes, I give you very good highlights. I expound on what you have done in the morning. All right. And then, of course, that video, you'll always get that video on my Facebook account. Of course, I know it's quite sad to some students, but you know, this semester is really squeezed. Yeah, this semester, 3 months, they're not really very much enough to enable us, in this case, here, do what here, dispense proper knowledge to you. That is why we will have to go an extra mile to ensure that you understand these things. All right. So are there guys who are normally available in the evening? Are there guys who are normally available in the evening? Are there guys who are normally available in the evening? Like yesterday, is there anybody who came to my yesterday's class? Is there anybody who came to my yesterday's class? Or was I just teaching strangers? Ah, they were there. Oh, great, great, great. So if you attend that class, then automatically things become what here, become easy. And again, remember, in that class, I teach all subjects, like AAA, right? Like LM, all right? And of course, given my years of experience in this industry, given that I'm a practicing auditor, among many other things, you cannot go wrong being in those classes. And they are again free of charge for you guys. We shall not charge you anything extra. It's just like, for example, good high schools. They have remedial classes. They have remedial classes like that. Thank you. Good day. Yeah, I shall be sharing the link in good time. Yes. Thank you so much. All the best. 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 Good day. Bye. Bye-bye.